Ladies and gentlemen, the GIC, Government Investment Corporation of Singapore, has just released its latest results, and the results doesn't look that exciting. And I think it's important for us Singaporeans to take a look at how it has performed and what are the underlying reasons why some of these things are moving in a certain way. And more importantly, are we supposed to be concerned with our country's money or heavily into it? Let's just watch on all the way to the end. I'll give you my key takeaway. So to start off, some of you have written to me and say, "Ayo, Mr. Lu, how come the GIC returns are falling?" Well, I think it's important for us to take a look. So the Singapore Sovereign Wealth Fund GIC posted its slowest investment return in 5 years. So its 20-year annualized real return, which is its primary performance metrics, came in at 3.8% as at end of last financial year. And that's marginally below the 3.9% posted a year ago, and is the weakest performance since 2020 when the return hit 2.7%. So quite disappointing on the surface, but let's drill down and see what the details are. So the fund, which manages an estimated $800 billion in asset, according to Sovereign Wealth Fund Institute, is one of the three entities overseeing Singapore National Reserve alongside Temasek and MAS. Now, $800 billion is a hell of money. Nobody really knows what's the total amount of asset that we have. I believe it's in a tune of 1.5 to $2 trillion at least, and that's maybe a conservative estimate, okay? But I don't really know what's the number, and it's a bigger state secret. But nevertheless, Temasek earlier this month, reported an 11.6% year-on-year rise in its portfolio, hitting a record high of $434 billion. And that's pretty remarkable, right? Now you will say, how come Temasek can have such a great performance and GIC not so good performance? Well, CEO of GIC actually said that the 3.8% annualized real return is very respectable. Okay, and in US the private sector is very strong. Now let me say again, the 3.8% is a real number. The nominal number is probably about 5.7-ish% or something like that. So actually that number is enough to pay for your CPF 2.5% and 4%, just to be very clear. Okay. So it's still rising. But of course, you say that, how can number be going down when the numbers are going up? Well, I think largely because, it is a period of turmoil as at March 31st in 2025. Well, if you look at the whole picture, according to GIC, we will say that the fundamentals are net positive. Now, the Group Investment Officer, Brian Yeo, acknowledged that valuation in some classes, such as public equities, appears elevated in the United States, but they will continue to find more asset, especially in this thing called infrastructure. Infrastructure is an area that GIC finds significant opportunity at global scale, especially including the US, and they could generate some good returns and a good hedge against inflation. Now, try to understand what on earth is infrastructure. I would believe you include things like bridges, roads, I don't know, trains, railways, and things like that, and maybe even data centers and things like that. I try to search, and I think that's the only thing I can find. So you might have a different interpretation, and I'm happy to be corrected. GIC was not only investing across the AI value chain, but also integrating AI into its operation, including for reviewing deals. So let me say again, even GIC is deploying AI. So the AI is very, very important. And for those people who are attending our course in AI, we will try to level up everybody's skills as much as we can, from very basics all the way to as much as we can. But AI is something that is really, the train have left the station. We got to play catch up in a big way. So equities for GIC account for more than half of its portfolio, up from 46% a year ago. And that's because there's increased US exposure in a time where everybody is crying murder about US. I don't know why there's so many Singapore narrow-minded investors keep saying that, wow, Singapore investments, STI is going up, Singapore banks is going up, and then US, Donald Trump is creating hell, and the US dollar is coming down, the US debt bubble is going up. Hello, our GIC have at least $800 billion of asset, of which half of them is in equities and a lot are into US, okay? So fixed income fell to 26% from 32%. Real estate infrastructure is about 23%. These numbers are quite important also for individuals, right? You think about it. So a big corporation at GIC, half of it is equity, about a quarter of it is in fixed income, a quarter of it is in real estate and infrastructure. Now, this could be a metric for individuals as well, right? So its exposure to Americas rose to 49%, of which, when I say Americas, I think it includes the Latin America, maybe even Canada and things like that. I imagine bulk of it, right, is in US. So out of that total $800 billion, half of it is in equities, of which half of that is into United States. That's very good yardstick for many of us. Asia Pacific declined to 24% from 28. So APEC is going down. Europe and Middle East and Africa steady at 20%. And Asia Pacific, in particular, China, valuations are lower, meaning that the markets have discounted less positive news and more negative news. Having said this, valuations not everything. Now, I just want to say this. You notice that despite our terrific performance in Singapore, no mention about it. Okay. So half of GIC equities was invested in equities and allocated to Americas. So you can see US, half of it is going up. Asia Pac is this, and global is this. The dark blue lines are ratios that maybe we should take a chapter in as well. Okay, you need not exactly follow it, but this is a very good yardstick. Do you think you're smarter than the GIC investors? Okay, now a lot of you all say, oh, Lemma, they only give 3.8% real returns and things like that. Hello, that's because they want to manage volatility, right? So the volatility is actually very low. So they did give a warning on private equity. Now, most of us will not have a chance to touch private equity, but I just want to say this, right? Private equity space is a space where a fund manager gathers a lot of money and lends out to companies that could not raise money in the public market, but in the private market, they could raise money. So they were done due diligence as much as possible. But this kind of funds, GIC give warning. So if GIC give warning on what I think is pretty, I wouldn't say safe, pretty decent, proven kind of business model, those people that touch crypto and all this kind of thing, I think it's way too dangerous. So basically, GIC say that we are in a part of a cycle where we feel that the spread a lot tighter and valuation is a lot higher. Hence, we are raising the bar in terms of further deployment into private credit space. So now we talk about the 3.8%. You can see it's coming down. It's coming down. Ta, 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 ta. In early 2000, it's near 6%. Take note, these are real return. You got to add about CPI inflation rate about 2%. So here it's probably doing around 7% ish and coming down, coming down. Sometimes it goes down, up, down, up, down, but generally above 2%. Why? You notice, right? In 2008, global financial crisis so jialat, negative 50% something like that. It still give a positive return, right? It's a rolling 20-year return. And I think to calculate this is quite important. Rolling is a bit complicated. So basically, it's a kind of like an average of 20 years moving forward. So these kind of return measurements will take away the noise of year-to-year movement, but certainly it's numbers coming down is not something we like to see. And I think it is in this space that they basically, by avoiding the private credit space, they are actually indicating that they really take a low risk approach in investment. Just to be very clear, okay? GIC don't have a huge exposure to Singapore. Most of its exposure is into US. So for those people who think you're very smart, okay, better than GIC investment, we have GIC now having a huge exposure into US despite all the risks that we all know. Just to be very clear, to the extent that the US is allowing GIC to deploy more capital, they will, okay, they will, because $800 billion can move the market. And despite the shift away from APEC, GIC continue to see opportunities there. So Group Investment Officer Brian Yeo said that the fund expanded its investment team in Japan over the past years and continued to evaluate deals in India and China. GIC have anchored a few recent IPO in Hong Kong as a cornerstone investors. You did not hear GIC has anchored a few IPOs in Singapore. Okay, really, right? So it is something that we just have to be cognizant of. Now, these things will change over the MES revamp of the whole thing. But at this point right now, GIC is heavily geared towards overseas. Our base case is really lower growth on margins, higher inflation. We have to get over the higher valuations as we see in India, okay, and so on. So my key takeaway is this: GIC manages its asset to achieve stable return on low volatility. So that is why the returns rate are much lower than we all hope it to be, because it has low volatility. And because it bets heavily, interestingly, it bets heavily on US, despite all the turmoil that President Donald Trump brings onto the US investment scene. So if GIC will do it, you should take a chapter and see whether you want to do it or not. GIC does not have a huge exposure to Singapore assets, contrary to many bulls that believe in STI, SGX, DBS, OCBC, UOB, and other Singapore stocks. Okay, GIC don't have a huge bet on it, and I need to also say this, that it doesn't mean that GIC is not loyal. It doesn't mean that Mr. Lu is not loyal. It's that basically, all your assets are into Singapore already. Meaning that all your income, your CPF, your house, everything is Singapore. Why do you want to bet also your stocks in Singapore, right? So I think it's geographical diversification, which I think will be wisdom. Now, a lot of people say, Mr. Lu, GIC just need to do is to throw all into S&P 500. It will make 8 to 12% return. That is true, but it will have a lot of volatility which you and I cannot tahan when our national returns are there. Would you like to see your CPF having this year negative, next year high, this year negative, next year high? Okay, so I think that's what it's trying to do. But however, I personally think that the exposure to US of 50% in my opinion is still on the low side. If you look at some of the funds, they actually have slightly more, maybe 60, 70%, but I'm not as good as GIC fund managers. I don't want to pretend I can outdo them. But certainly holding, Singapore and Singaporeans crown jewel is a very huge responsibility. They cannot suka, and put it at risk. So it's easy for us to point fingers, but I think 3.8%, not as good as we hope, but at least it still pay the bills, right? Your CPF in terms of OA and SA is still well returned. Okay, let me know your comments, and I'll see you tonight for live stream.